It's time for the Your Personal Bank Show with Ference Toth. In an era of chaos, confusion, and craziness, Ference is a voice for common sense. As a financial literacy educator, speaker, and entrepreneur, Ference cuts through the noise to help us understand how current events affect our money, economy, and our freedom. Now, here's Ference Toth.
Welcome to the Your Personal Bank Show. This is Ference. If you want to reach me, you can do so at yourpersonalbank.com. Email Ference, F-E-R-E-N-C, at yourpersonalbank.com. Ference, no E on the end, F-E-R-E-N-C, at yourpersonalbank.com, or 866-268-4422. Recently, one of the largest IPOs in history, SpaceX, has occurred. There's been a lot of interest about this. There's been a lot of hype and excitement. There's no doubt that Elon Musk has been very successful with a number of companies. He's probably the greatest entrepreneur of our generation. SpaceX itself has some amazing technology. I use the Starlink technology myself. It's excellent high-speed internet, especially in areas where there is a lack of high speed. It's a phenomenal tool. All of these things I agree with. And when you price an IPO, you don't sell what the company is, you sell on what it could become. That's natural and that's normal. SpaceX has written one of the most ambitious could-be companies in history. Their filing claims a total addressable market of over $28 trillion, which is larger than the entire GDP of the United States currently. Now, the breakdown is space. They're projecting $370 billion, Starlink $1.6 trillion, and AI $26.5 trillion. Now, that is an astounding number when you consider that 93% of the market SpaceX is selling is AI software that does not build, doesn't sell, and it doesn't own. It also listed in its perspective for real future markets, space tourism, orbital manufacturing, transport to the moon and Mars, energy generation on Mars, and yes, even asteroid mining. See, SpaceX is listing at about 90 times revenue, and the problem is the price, not the technology. I believe that SpaceX will be a company that will be a technological leader in the future. If you look at the past 45 years of IPO data, companies that debuted above 40 times sales volume underperformed the market by over 58% over the next 3 years. See, the golden rule of IPO investing is the lower the price to sales at entry, the better it will be long term. As exciting as IPOs can be, as much hype as they receive, and I'm not trying to throw a lot of cold water, I just want people to understand the reality that we've seen over and over and over again. And many of these IPOs have been tremendous companies themselves. Companies like Airbnb, Coinbase, Uber, Facebook, leading companies in their respective industries. If you look at the 10 largest IPOs in history, they went down an average of 35% in their first 6 months. Many people are calling SpaceX a generational entry. We saw that with these other companies. On average, large IPOs over the past 15 years have lost over 50% of their value in the first year. And the other issue that SpaceX has from a pricing standpoint, listing at over 90 times revenue, 95% of the shares owned prior to the IPO were owned by insiders. And many of the typical rules with IPOs have been changed for SpaceX. There's usually a period of time that insiders cannot sell their stocks, their shares, after the IPO. It's often 6 months. The rules have been changed for SpaceX so that some of the insider shares will be able to be sold in a much, much shorter period of time. So what is a probable outcome of what will happen is SpaceX clearly has a lot of hype and excitement around it. And typically what you'll see is prices will jump rather quickly. And at about 15 days after issue, because SpaceX will become part of the NASDAQ, many of these index funds will then be forced to purchase. So you'll have a large number of buyers about 2 weeks or so after the IPO is issued. So you're going to have a lot of buyers in the first couple of weeks or so. But then after that point, you're going to have a lot of insiders that will have the ability to sell. The indexes will have purchased their positions by then. And based on history of previous IPOs, you often see quite a downslide, the average being over 50% over the next year. So if you're going to play this IPO, proceed with caution, probably short-term excitement, hype, more medium-term, let's say the next year or two, could be pretty rough. If you're not able to get in really early, or you don't want to play the short-term game, which will be highly volatile, frankly, most likely, it might be a good idea to wait for some bottoming out and maybe get into it at some point down the road. So those are just some thoughts. Again, I'm not trying to pour cold water. There's so much excitement around this. I understand. But you have to look at the numbers and you have to look at history to see what is the most likely scenario. The tremendous run-up we've seen in the last couple of years in the stock markets has undoubtedly been driven primarily by the hype surrounding AI. That narrative is rapidly changing. Some are even now stating that the AI bubble has already burst. And the reason they point out to this fact is this is exactly why so many companies are now racing towards IPOs. They want to sell at peak valuations before financing problems, data center delays, power constraints, missed targets, and guidance cuts start hitting the market. I've shared this now for easily over a year, where I do believe AI will fundamentally change the economy, much like we saw with the internet. And we saw the internet.com run up and then bubble burst, primarily because the hype and the expectations far outpaced reality. Eventually, the internet did fundamentally change the economy. It didn't really happen until about a decade later. There were fits and starts, there were delays, there were frustrations, and many of the companies are starting to realize that these data center delays or financing problems are starting to pop up, which will delay implementation that much of the hype was proposing. And unfortunately, investors that got ahead of their skis, so to speak, come to realize this, and that's why the dot-com bubble burst, and many are predicting the similar scenario with the AI bubble. In fact, Citadel Securities just put some institutional weight behind what many don't want to say out loud, and it's a new macro note they titled Tokenomics. And they're making the argument that the most powerful technology on Earth still has to pass through the boring discipline of cost curves, capacity limits, and marginal returns. And the evidence is piling up. Amazon removed its token usage leaderboard. Microsoft canceled its Claude Code subscriptions because it costs too much. This is a technology that they themselves invested billions into. And multiple companies have been reporting unexpectedly massive bills and expenses. And Citadel Securities' conclusion is economics matter. See, it's no longer about adoption of AI and what it can do. The narrative is starting to revolve around the price needed to run at scale. Computing power, cooling, memory bandwidth. These are all real binding constraints. It's economics 101, folks. It's not just what a technology can do, but how much does it cost? And when the price of something gets too high, people either start using less of it or find a cheaper version. And the early part of nearly every technological revolution ignores this. They focus on the narrative about what it can do instead of the economics of how efficient or how effective it will be. See, the hype is all about what AI can do, and frankly, it can do some amazing things, and likely over time, even more so. But the reckoning comes about when people realize, what does it cost? One of the last points about IPOs I want to make is we saw this before in the dot-com bubble. As the index climbed from 1995 to 2000, we saw an increase in IPOs. 1995 was Netscape, then in 96, Yahoo. Amazon in 97, eBay in 98, and then something most of you may not remember called theglobe.com. Each of these IPOs was bigger than the last. They got bigger, they got louder, they got more frequent. And the last one, theglobe.com that I referred to, had the largest first-day gain ever in history. It jumped over 600% in value its first day. About 10 years later, it stopped business operations as worthless. See, IPO supply doesn't peak at the bottom when stocks are cheap and nobody wants them. IPO supply peaks near the top when the public will pay the most and the insiders are most eager to sell. So a rising tide of listings is not a sign of a healthy market. It's the sign of people who own these companies selling them at the peak. It's often a symptom of the end of a bull market. If any of this concerns you, you want to protect your downside. This is the golden era of fixed assets. We're seeing the highest returns in index products literally over 40 years. If the tide continues to rise, you can take advantage of these products. We have indexes that have averaged 12, even 15% average annual returns over the last 20 years with no downside risk. When you lock in the gains, they become your new principal. Therefore, if this ride continues, you can enjoy it. But when inevitably it turns, you can keep your gains. We also have products that allow you to lock in your gains at any time. Contact me at yourpersonalbank.com for more information. Stay tuned. Next segment, I'm going to discuss some more points about the market in general.
I'm Ference Toth, host of the Your Personal Bank Show. This is the golden era of fixed assets. Annuities and guaranteed lifetime income are paying the best rates in over 40 years. If you looked at annuities over 2 years ago, the numbers have increased significantly. If you own an annuity over 2 years old, the new products can not only pay your penalty to switch, but are often guaranteed to outperform your current product. For more info, contact me at yourpersonalbank.com or 866-268-4422. That's yourpersonalbank.com.
Welcome back to the Your Personal Bank Show. This is Ference. If you want to reach me, you can do so at yourpersonalbank.com. Email Ference, F-E-R-E-N-C, no E on the end, F-E-R-E-N-C at yourpersonalbank.com or 866-268-4422. Investors have never been more concentrated in stocks. When you look at the total stock allocations across households as a percentage of total financial assets held, it's over 51%. This is the highest percentage ever recorded on record. To put things in perspective, the last time the percentage was anywhere near this high was at the peak of the dot-com bubble, where about 45% of households' net worth was allocated in stocks. There's something called the S&P 500 CAPE ratio. It's spelled C-A-P-E. This is a measure of how expensive stocks are relative to their long-term average earnings adjusted for inflation. It's a really good measure of the valuation of stocks, whether they're overpriced or not. The S&P 500 CAPE ratio peaked at about 44 times in 2000, the peak of the dot-com bubble. We are currently over 41 times. This is the only time in history that we've been anywhere near this close, this extreme valuation. When you put these two pieces together, we're over 50% of the total financial assets held by households, corporate, financial, and foreign sectors is the highest level on record. You're at one of the most expensive valuations in the history of the stock market. Nearly anyone who's going to invest in stocks has already done so. What this means is there's very few buyers left to push prices higher. Where are they going to come from? There's very few buyers left. Another point of concern is how few stocks are actually pushing the prices up. Recently, the S&P just hit another all-time high. but only 20 of the 500 stocks in the S&P 500 hit a new all-time high with it. The last time this few number of companies hit an all-time high while the index did so was March of 2000. That was the exact top of the dot-com bubble. Later, the NASDAQ lost over 70%. Another key point about this is over 200 of the S&P 500 stocks are down over 20% from their highs, and another 100 of them are down over 40% from their previous highs. Barely half of the S&P 500 trade above their 200-day average. This narrow of a breadth, this few companies that are pushing the overall index up, has only happened 3 times in history in world markets. It happened in 1929, in Japan in 1989, and March of 2000, and now again in June of 2026. Each of those times previous was a tremendous downturn occurred shortly thereafter. Let me give you another point here that a lot of people are not aware of. Every year since 2003, there has been a shortage of stocks available to purchase. It's called shrinking supply. And the reason behind this is quite simple. Many companies that have grown and become profitable over time do stock buybacks. They take a portion of their profits and they purchase some of their stock back. By purchasing their stock, they reduce the supply of stock, and that's one way to increase your overall stock price. Fewer stocks available, basic supply and demand, your price per share goes up. And for the past 23 years, again, since 2003, every year there have been fewer stocks available because of these share buybacks. 2026 is the first year in 23 years that the opposite is now true. These large IPOs, SpaceX, Anthropic, OpenAI, are also adding to the overall supply of stocks. Fewer companies are now buying back their stocks, Google being one of the most famous ones for purchasing tens of billions of dollars of their stock nearly every year. This year has stopped doing so. The large IPOs of SpaceX, Anthropic, and OpenAI are adding millions and millions of shares to the market, which means there'll be more shares overall available. So the first time in 23 years, instead of having shrinking supply, we now have expanding supply, more available. That, in general, will push stock prices, downward. And another point of concern is leverage. When optimism to the extreme levels, people and institutions will borrow money to buy stocks or take on margin debt. If you measure the change in margin debt, when it gets over 55% increase, optimism has gone rampant, and people are loading up on leverage, oftentimes in the late innings of a bull market. This measurement of margin debt crossing over 55% has flagged every major top since the 1970s. Today, overall margin debt stands at over 53%. It's not quite at the 55% mark, but it's getting really close. And margin debt overall as a share of GDP just also hit an all-time high. 70% of Bank of America's market peak signals have been triggered, which is the average seen on prior tops. Now, irrational exuberance, which many are starting to call this current market, in and of itself doesn't necessarily measure a top. It's hard to time the markets. Markets can stay irrational far longer than people think, or even far longer than seems possible. When the prices leave rational justification and move into speculation territory, the price then really becomes what's the next person willing to pay for it. When things are moving up and moving up rapidly, often feel like genius on the way up. But it's also, leverage is also the thing that turns a normal correction into a forced liquidation on the way down. You see, borrowed money always gets called back, and it usually happens at the very worst time. So when you have all-time levels of leverage, that also creates all-time levels of volatility and risk to the downside. You could have just a normal 10 or maybe 20% correction, but when you 3-time lever funds and all these margin debt and all these other types of things, this can cause margin calls and force liquidations, force people to sell, which, like a domino effect, accelerates on itself. These are the things you need to be aware of, and you have to stay really on top of a market like this, where the prices are at extreme levels because the risk is at extreme levels. The saying often goes, markets go up like an escalator, but down like an elevator. And that is true, especially with significant leverage. Again, I'm not trying to throw cold water or be a fearmonger or anything like that, but I am trying to help people understand where we are at, take a clear-eyed view, and use some logic and common sense of knowing where you're at so you can make better decisions, so you can not be caught up in the emotion and the hype, because that's when people make poor decisions, or fear for that matter. We all know as human beings, when we're making a highly emotional decision, that's typically not our best decisions. But when we have facts, knowledge, experience to back us up and remove the emotion from the decisions, especially when it comes to things like money, which I understand it's extraordinarily difficult to do, but it is absolutely necessary to make solid, logical decisions. I'll give you a perfect example. SoftBank was pledging all of its OpenAI stock, which was on paper worth about $60 billion, to attempt to get a $6 billion margin loan. So they were pledging, on paper at least, 10 times the collateral to get a loan, and they were turned down by essentially every bank due to concerns about the true value of OpenAI stock. Take a good hard look, and underwriters look at the true value of these stocks. The bank underwriters clearly do not believe that OpenAI is worth $852 billion, or nowhere close to that. They were not even willing to loan to SoftBank 1/10 of the value of the stock that they owned. They were discounting it that much. When serious bank underwriters are looking to underwrite a loan, are not willing to justify prices 10-to-1 ratio, you need to pay attention to that. There's always winners and losers. And there's no doubt the last few years, the stock market has been the recipient of significant increase in values. Last couple of years, primarily due to the AI hype. Prior to that, to the low interest rate environment that the Federal Reserve primarily keeping interest rates far below levels that we had ever seen for over a decade, which inflated asset prices significantly with stocks, real estate, etc. Those things are changing. The AI narrative is changing significantly, and interest rates have changed significantly and likely will do so even more, which I'll discuss in this next segment. If you want to protect yourself, if you want to continue to grow your money, lock in gains when they occur. In fact, you can lock in at any time with no downside risk. Some of the best index products I have seen in my career, literally. We have indexes that have averaged 10, 12, even 15% average annual returns for the past 10 and 20 years. This is net into your account with no downside risk. Contact me at yourpersonalbank.com for more info. Stay tuned in the next segment. I got a few more things that I think you'll find quite interesting.
This is Ference, host of the Your Personal Bank Show. My show focuses on creating tax-free buckets of money, insured, guaranteed, highly liquid, and the ability to create positive arbitrage. Did you know this is the best time in over 40 years to invest in index annuities? An index annuity allows you to 1. Grow your money safely without market risk. Once gains are locked in, they're guaranteed against future market loss. 2. Double-digit potential upside on good market years with no losses in bad years. Principal is guaranteed. 3. A 7 to 8% fixed interest option is available in the first year. If you're interested in growing your money with potential index-related gains without downside market risk, this is the best time in over 40 years to consider an annuity. If your annuity is over 2 years old, the newer products likely have far superior potential returns. Please contact me at yourpersonalbank.com or 866-268-4422 for more info. That's yourpersonalbank.com.
Welcome back to the Your Personal Bank Show with Ferenc Toth. Want more information? Contact Ferenc at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422. Now back to the show with Ferenc Toth.
Welcome back to the Your Personal Bank Show. This is Ferenc. If you want to reach me, you can do so at yourpersonalbank.com. Yes, you will reach me. Email Ferenc, F-E-R-E-N-C, no E on the end, F-E-R-E-N-C at yourpersonalbank.com or 866-268-4422. And like I said, many people are surprised when they reach out, but yes, you will be able to get in contact with myself, not an assistant. When I'm sharing what many would consider unfavorable news, particularly at a time when enthusiasm, excitement, and hype are at all-time levels, also understand it's not popular. And sometimes people get a little upset and even frustrated with me, accusing me of being a fearmonger and things like that sometimes. Often I find because I'm sharing information they probably don't really want to hear. And I'm not trying to be a fearmonger. Generally speaking, I am an optimistic person by nature. I'm very optimistic about the longer-term future of the U.S. economy in particular. But what I am becoming increasingly pessimistic about is the short term. As these asset prices continue to climb to unprecedented levels, and this is my 27th year in this business, I've been through the dot-com bubble and bust. I've been through the Great Recession and bust. I saw how the enthusiasm, the hype, and the excitement affected people. I also saw how they got hurt and damaged and financially and depressed even and had to go back to work or keep working for another 5 years or longer because of the losses that occurred. I've seen both sides of the coin twice before in my career, personally. And I just can't ignore when I see the same things happening, the same signs, the same indicators. In fact, it's like deja vu. I feel like I'd be doing a disservice if I didn't share my perspective and help you at least have a little bit more balanced view on where things really are at. Better understanding of where the risks are or how high the risks are, and are you willing to accept that risk? Look, if you're willing to accept it, that's your decision. You're an adult. I can't tell you what to do or force you to do anything. But if you're going along believing one narrative that everything is hunky-dory, wonderful, and is just going to continue forever, we hear that, when the reality is probably far from that, is probably far different, and you're at a risk of getting burned, maybe burned badly, I wouldn't be doing you any favors if I knew otherwise. Let me give you a quick analogy. Let's assume it's night. You're driving down the road, and I know that the bridge ahead is out. And I've stopped and pulled over, and I see you coming down the road. Would I just let you keep driving and find out for yourself? Or would I try to flag you down and warn you that, hey, be careful ahead, the bridge is out. You might want to slow down or turn around and go a different way. That's where I believe we're at. Now, do I know when it's going to happen? No, no one does. That's impossible to predict. Do we know how much, how far this continued climb is going to occur? No one could tell you. No one knows. I can't tell you the date. But what I can do is tell you the season. We can identify the season and the signs. Just like when the leaves fall, we know winter's coming and it's going to snow. We don't know which day it's going to happen and the first freeze, but we know it's going to freeze and it's going to snow, unless you live in Florida or Arizona or someplace like that. But you see my point. And that's all I'm trying to do is, hey, I'm trying to flag you down and say, hey, you might want to slow down a little bit. Don't keep barreling down the road because the bridge might go out or the leaves are falling. Winter's coming. It's going to freeze. You might want to get prepared and have what you need to cover up those plants when that occurs. That's my point. And why I say the risk is so elevated, not only just the levels, extreme levels, almost every indicator, every measurement you want to take, we're at highs never seen before, like in the history of the markets, 150 years plus. But on top of that, when the AI breaks, the narrative breaks, this is what a lot of people don't realize. Oh, it's just going to affect those. No, the broader market could fall 40 or 50% itself very quickly because the indexes are so heavily tipped towards AI right now. Most indexes no longer diversified investments by any definition of those words. Nearly half of the S&P 500, for example, and majority of NASDAQ are tech or AI related. So what's happened is the risk has been concentrated far more than at any time ever before in history. That's just a fact. And I guess I do follow the mantra to some extent, made famous by Warren Buffett, where he said, be fearful when others are greedy and greedy when others are fearful. Well, folks, I see a tremendous amount of greed. And as that greed continues to increase, I continue to get more fearful, just like Warren Buffett. This is why Berkshire Hathaway is now sitting on the highest level of cash, both in percentage and total dollars amount, his entire investment career. In fact, Berkshire Hathaway has almost $400 billion of cash and could literally buy over 475 companies of the S&P 500 today. Completely, just buy them out. All but the top 25 or so. Why doesn't he? Well, his actions speak very loudly. He believes prices are far too high. He's been the indicator that was famously named after him and is his own favorite gauge of the price of stocks just hit the highest level ever at 238%. What this means is the entire stock market is now worth twice as much as everything the country produces in a year. It's the value of the entire stock market to GDP. It's at an all-time record. It's higher than 2000. It's higher than 2008. As Warren Buffett famously stated, I've never seen people in a more gambling mood than ever. It's like a church with a casino attached. And this is the man that's been often touted as the greatest investor in history. He survived nearly every bubble, walking out before the music stopped. He and others have stated, to win, you have to leave the party when the music is still playing loud. And that's really, really difficult to do from a human behavior standpoint. And it's not just Warren Buffett. Bank of America has now stated that 70% of their bear market indicators have been triggered. Bank of America's official position is it is now time to take profits. They went on and explained that the AI bubble is showing more and more cracks and that retail investors always arrive last. Many who are chasing AI stocks at these valuations may end up trapped for years waiting just to break even. See, every bubble looks unstoppable until reality hits, and then it's not. The Shiller Index, which is another measurement of stock valuations, has now predicted they expect the S&P 500 to have negative real returns over the next decade. See, about a year ago, they were predicting about a 1% return over the next decade. Now they're stating negative. The Shiller's model forecast is predicting something like a 50% average collapse and then a slow climb back to only be slightly negative a decade later. And folks, we've seen this before. I went over this with a client literally today, showing if you were invested in the S&P 500 in 2000, beginning of 2000, you didn't get back to even until about 2007. It was about 7.5 years later that you got back to even. And then guess what happened in 0809? We had another significant drop, about 45%. And it was 2013 before you got back to where you were in 2000. This is just the S&P 500. By the way, the NASDAQ was even more dramatic. It was famously called the lost decade. That was the reason why. And this is nothing new. Let me give you another example. We can go back in time to 1972. There was a list of stocks back then that you were supposed to buy and never sell. Many at that time called them one decision stocks. You made one decision to buy and then you held forever. And the reason was the quality was just so obvious with these companies, and the futures were so certain that the price was considered irrelevant. It was called the Nifty 50. Many of these companies included Coca-Cola, Disney, McDonald's, Xerox, Polaroid, IBM. These were the best companies in America at the time. And at the peak, this group of stocks, the Nifty 50, traded at 42 times earnings. We are at those levels right now as we speak. Some of those companies were trading much higher. For example, Avon, 65 times earnings. Disney, 82 times. McDonald's, 86. Polaroid was trading at 91 times earnings. And then 1973 happened. What happened then? Inflation, high interest rates, recession. And a Forbes article pointed out the Nifty 50 were taken out and shot about one by one. That was a quote. Coca-Cola lost 69%, Xerox 71%, McDonald's 72%, Avon 86%, Disney 87%. Polaroid lost 91% and eventually went bankrupt. These were the best top 50, the Nifty 50, the best companies in the country. They weren't bad companies. Most were genuinely great businesses that had been earning profits for decades. It wasn't the companies that were the problem. It was the prices. For example, if you had bought the Nifty 50 in the peak of 1972 and held those companies for 25 years, you eventually would have matched the market because the quality would have bailed you out. But you would have had to survive a 50 to 90% drawdown first, and most people will not survive that long term. They'll give up. Buy quality and hold forever is good advice. I hear that all the time. But buying quality at any price and holding forever is not good advice. It wasn't about the decision to buy the quality. It was always about the price. And Warren Buffett understands this probably more than any other investor out there. And if you want to give me, well, that's old news, let me share one that's happening today. Apple, probably considered one of the top companies to own from a quality standpoint. Apple now trades at over 10 times sales, the highest valuation in its history. Here's the problem. In 2022, Apple's revenue was about $400 billion. In 2023, it actually went down a little bit, which was its first decline in years. Was its first decline in several years. 2024, still just shy of $400 billion, and in 2025, about $415 billion. In 4 years, less than 2% growth, or essentially flat. Yet at those same 4 years, the stock has soared, and it's nearly doubled in price. So the revenue has barely moved, yet the valuation has exploded. Every dollar of the gain didn't come from Apple selling more. It came from investors agreeing to pay more for the same amount of sales. You see, this feels like growth. It's not growth, it's hype. Apple's long-term average price to sales ratio is 3.6 and now sits at over 10. It's over 3 times its historical norm. So either Apple is going to suddenly re-accelerate hyper revenue growth, or after years of stagnation, or the multiple holds at the highest level in company history ever. Math says multiples revert. They always do. This is your quiet danger existing in what many consider the safest stock in the world. Look, nobody worries about Apple. It's one of the ultimate quality stocks. Many consider it a permanent holding. But even if you buy Apple, at an all-time historical price, you can lose money for a decade because you paid 3 times the normal price. It's not about the quality or the technology. It's about the price. It always has been, and it always will be. If you want to protect yourself, grow if the markets continue yet have no downside risk, and then re-engage at some point in the future after a correction occurs. Index products, IULs, cash value policies can produce these types of things for you. Some are highly liquid, some are not. Depends on what you're looking for. Indexes that have averaged 10, 12, even 15% average annual returns over the last 10 and 20 years. In your pocket, net, with no downside risk. If you want more information on this, contact me at yourpersonalbank.com. Stay tuned in the last segment. I have some information here that will put chills up your spine. You don't want to miss this.
I'm Ference Toth, host of the Your Personal Bank Show. This is the golden era of fixed assets. Annuities and guaranteed lifetime income are paying the best rates in over 40 years. If you looked at annuities over 2 years ago, the numbers have increased significantly. If you own an annuity over 2 years old, the new products can not only pay your penalty to switch, but are often guaranteed to outperform your current product. For more info, contact me at yourpersonalbank.com or 866-268-4422. That's yourpersonalbank.com.
Welcome back to the Your Personal Bank Show. This is Ference. If you want to reach me, you can do so at yourpersonalbank.com. Email Ference, F-E-R-E-N-C, no E on the end, F-E-R-E-N-C at yourpersonalbank.com or 866-268-4422. Yes, you will reach me, not an assistant. When I share the type of news I've been sharing today, I have to consistently repeat myself because some people think that they get upset, they get frustrated. I'm sharing news that's not popular, many don't want to hear, and I'm doing it at a time when enthusiasm, excitement, and hype are at or near all-time levels. I understand what I'm doing and saying is not popular, at least not today. Eventually, it will be. And some people even accuse me of being a fearmonger or other things like that. No, that's not my purpose or goal here. My purpose is to educate you and help you understand what is going on, some of the facts, and take a more balanced view rather than taking the emotional view and buying into the hype or falling into the fear, the FOMO, fear of missing out, or any of those types of things. Because again, we all understand this as human beings. Your best decisions are made when you have facts and logic, not emotion. If you're highly emotional in your decisions, that's when you tend to make mistakes, especially when you're talking about financial decisions. I want you to make better decisions. That's my goal. That's my purpose here. I also want to educate you and help you understand there's alternatives. There are index products where you can gain tremendous upside gains. I have many clients that have earned over 20% last year on their index products, but have no downside risk. Once they lock it in, it becomes their new principal. So these gains that they receive, they get to keep them when a correction occurs. They don't participate in the downside. When the recovery does occur or the rebound after a correction, they get to take advantage with more money because they did not participate in the downside. There's another way. That's the point I'm trying to make and help people understand and educate. There's 2 things I want to share with you here that are some of the most powerful points I think I've seen in a very long time. And the first one is this. Some of you are old enough to remember this, some were not. Some of you were invested in 2000, or maybe you didn't have that much invested at that time. Maybe you were still working, still contributing. So it did not impact you as much. And that's why you're not recognizing the signs this time, because maybe you're nearing retirement or are retired now, but 26 years ago, you were still working and your portfolio likely was probably a lot smaller back then. And the fact you also many were still contributing to IRAs and 401ks and et cetera, it masked the losses because you were still adding monies to it. Well, as you near or get into retirement, you don't have that ability or option to keep adding into an IRA or 401k or any other investment for that matter, typically. So losses are more pronounced because you're not adding money to it. They're not masked so much. So this is a blind spot for many people. Basic financial literacy. I taught it for a few years, college certified. This is important stuff. So here's the 2 key points. So let's go back to 2000. It's the height of the dot-com bubble. There's a lot of excitement, a lot of enthusiasm, a lot of hype. There's big IPOs coming out. Everybody's excited. People are making money. Their portfolios have been going up. We've seen some people getting 100% returns in a year. I remember in 1999 meeting with a doctor who had made just over 100% return on his portfolio the previous year. Sound familiar? I've met people recently in the last year or two did the same thing with stocks like NVIDIA or Planeteer. And I pointed out doing an index product where you could get a double-digit return in good years, no risk in the down year. And this doctor said to me, why would I do that? I made 100% return on my money last year. The reason is because next year there's no guarantee you're going to do that again or even make any gain next year. In fact, you could have a loss. He scoffed at the idea. He had bought into the hype. There was no listening to logic. Unfortunately, a year later, I knew what assets he had invested in. He had basically lost most, if not all, what he had gained the previous year, and then some. I just gave you an anecdotal story. Let me give you some factual information. It's 2000, height of the dot-com bubble, like I said. Everyone knows the internet is the future. Everyone's excited. There's irrational exuberance, as Alan Greenspan, the Fed chair, had stated previously. And you're looking at the stocks and companies, and you determine and decide that Microsoft is the best company you should invest your money in. But 9 years later, you're down 73%. How many people are going to survive a 73% downturn 9 years later and last that long? Most don't make it that long, so you can't take it anymore, so you sell. If you stayed in, if you managed to ride it out those 9 years, after 16 years, you would have finally broken even and gotten back to where you were in 2000. So 2016, you finally got back to where you were. And you had bought a quality stock, a great company. Did you make any money during that 16-year period? The answer is no. All you did is retrace old ground. Now, here's what's thrown people off. From 2000 to 2016, you made nothing. You lost and then finally got back 16 years later. And then from 2016 to 2026, what happened? The stock went up 43 times. Nothing was wrong with the company or the stock. You just paid too much for it. You bought it at peak valuation. If you own something like that now, going to repeat the same mistake? Now, what if that same person instead invested in an index product? I had many clients do that. Well, not only did you not take the 73% hit that Microsoft took over the next 9 years, you didn't lose anything. In fact, what happened is the markets dropped, the stocks dropped for a couple of years, and then you started to have a recovery. So a couple of years you didn't make any money, but you didn't lose either. So you didn't lose the 73% hit. And then during the recovery, you started to go up. And many of those years were significant double digits. I used an example today with a client. 2007, 2008, S&P 500 dropped about 45%. With the index product, they lost nothing. The following year, 2009, the index went up almost 19%. If you bought the Microsoft stock in my example, you were still well underwater and made no positive gains until 16 years later. And this is with a really, really good company. And here's the second point and last point I want to make today. When I saw this chart, I found it chilling, almost shocking, is they took basically a 5-year chart of the dot-com bubble and then burst. So the 3 years leading up and then the 2 years down. And they superimposed this chart, S&P 500, superimposed the chart on the past 3 years. It is absolutely shocking and eerie how similar they are. I've also often shared the history doesn't repeat itself, but it often rhymes. My gosh, folks, it's almost to the T. It almost totally rhymes. It's that close. If this chart, here's the part you need to understand, and what I'm going to leave you on and then give you a solution. If this chart continues to follow the same pattern over the past 3 years, the 3 years leading up to the dot-com bubble and the last 3 years of the AI bubble, we currently have about one more downturn of about 10%, one more up run, and then a 50% drop over the next couple years. And if it follows the same pattern, we have a few months left, if that. It's that close. Now, I can't say for sure it's going to repeat itself exactly. It's going to do the same thing. But here is the thing I do want you to understand. It has followed this pattern almost exactly the past 3 years, with many of the same catalysts driving technology that we saw in the internet and now we see with AI. If the risk is becoming too much for you, if the volatility is getting uncomfortable, if this doesn't fit your risk tolerance, and you are concerned that this market may indeed follow the same cycle that we saw in the dot-com bubble and then burst, there's another option. Index annuity products are the best we've seen in over 40 years. We're getting better returns than we've seen since the 1970s. It's the golden age of fixed assets. I have indexes I can show you with actual returns, average annual returns over past 10 and 20 years of 10, 12, and even 15% in your pocket, net. Unlimited upside, no caps. We have no fee products available and low fee products available. You could lower your fees or eliminate them entirely. Unlimited upside. Again, I'll say that again. People are shocked by that when they hear about index products. No caps, unlimited upside. Participation rates well above 100%. So these accounts can actually accelerate above what the returns are in the index if you were invested directly in the index. Probably most importantly, they guarantee the principal, no downside market risk. Once you lock in a gain, that gain becomes your new principal. You also have options available that allow you to lock in the gain at any time. These things were not available previously, even 2 or 3 years ago. If you have an index product, you need to look at the newer ones, and you will likely double or even triple your average annual returns. And yes, I've had folks get 22 and 24% returns even in the past year or previous years, in 1 year, in index products. It happens more often than you think. If you haven't had this experience, or this sounds new or different, or again, the risk that's out there, what's going on is concerning you, contact me at yourpersonalbank.com.
Contact Ference at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422. This show is designed to provide accurate and authoritative information.
Concerned about market risk? I'm Ference Toth, host of the Your Personal Bank Show. The S&P 500 valuations are higher than at any time ever recorded in stock market history. This includes 1929 and 1999. We all know what happened afterwards. It wasn't pretty. Elevated valuations increase risk to the downside. Annuities and Your Personal Bank offer unlimited upside with no downside market risk. Your principal is guaranteed. Contact Ference at yourpersonalbank.com to maximize returns, reduce market risk, increase liquidity, and reduce taxes.